Now, I'm starting with a daily chart of the NASDAQ Composite, and I just want to review the price action and my thought process over the past month or so. We had this correction in September, and when things started to stabilize towards the end of September, I was discussing how there were a lot of setups. I was slowly increasing my investment levels as we got back above the 50-day. And as we ran into this nice sort of surge we had into this Monday, October 12th move, I was on the high end of my investment levels, about 80 or 90% invested for clients. Now, as we started to pull back from there, everything was fine. I maintained my investment levels. We were building sort of a handle to this base, and the price action was strong. We were just pulling back on light volume. But then as we continued to slide, there were a couple of negatives. Number one is that beneath the surface, some of the leaders were showing a little bit more selling than normal. Number two is there were no setups, very few setups. As you know, I judge the health of the market on the price action of stocks, and I found that there were very few setups, and the ones that I did find and I was passing along weren't really working. They were failing immediately. So that was another negative. The third one was sentiment, meaning that usually sentiment moves with price, meaning human nature. As we go higher, it's natural for sentiment to people to get more bullish. As we go lower, it's natural for people to get more bearish. Now, even though this 9 or 10-day decline that we saw in mid-October wasn't any sort of brutal decline. Nevertheless, it was about 9 straight down days. And I look at many different sentiment measures, and they were increasing in bullishness, which was surprising to me, not only because we declined for a couple of weeks, but also because of the upcoming uncertainty around the presidential election. I would have liked to see people get a little more defensive. Instead, it seemed like people were very complacent with this upcoming uncertainty. So that was another negative. Now, at the positives, a couple weeks ago is that the major averages were still holding their key levels, mainly the 50-day moving average, and also the Fed is still on our side, keeping interest rates low and providing an equity-friendly environment. And whenever you get a mix of positives and negatives, what I like to do is keep things light and be patient until we get more clarity. And I try to practice what I preach. So during this decline, I reduced my investment levels from 80 to 90% invested down to about 20 or 30%. Again, just to be patient and let the market prove itself until we get more clarity. Now, to review what happened this week is we gapped down on Monday, and it was a distribution day. Wasn't heavy distribution, but again, beneath the surface, the leaders kept declining, and that's when I did a special webinar Monday night telling you that even though I came into the week lightly invested, I moved to 100% cash. I have a small SPAC, so tiny position, but for the most part, moved to a heavy cash position. And I also said that cash isn't for everybody. These are the times where you need to make decisions on whether you're a trader or you're an investor. Cash is more for traders. I'm also an active manager. I also can make decisions quickly. I just would rather lean towards being defensive because you can always get back in. And I moved to a cash position, and I recommended keeping positions very light. And if you're a longer term investor, at least getting off of margin and cutting some of your bigger losers to help free up some cash in your portfolio. Again, these are the decisions you need to make based on your own time frame, your own risk tolerance, your own investment objectives. Now, Tuesday, we popped back up, but it was on super light volume. And I remained in cash. And then Wednesday, we had a gap below the 50-day on another distribution day, which was above average volume. Sorry, I screwed up the line there, but you can see it was above average volume on Wednesday. Now, what I did was when we reached what I thought could be potential support, I took some super light positions in some of the leaders just to test the waters, dip your toe in the water a little bit. Still heavy cash, about 90% cash, but these are all light 1 or 2% positions to see how the leaders would react off of this support level. Now, part of the reason I do that is because I believe in what Jesse Livermore says, which is as the leaders go, so goes the markets. So I took some light positions. Now, what happened on Thursdays, even though we bounced, we did bounce nicely on Thursday. When I clear up the lines, just so you can see it, again, it was super, super light volume, but more importantly, beneath the surface. Some of the positions I took in Zoom and S-Gen, Seattle Genetics, now called C-Gen, and Tesla, some of these leaders, they were acting incredibly poorly beneath the surface. So I just cut those small positions and got rid of them because I didn't like beneath the surface that, one, the volume was very light on Thursday, and two, a lot of the leaders beneath the surface kept bleeding. So I've maintained a heavy cash position, and then we had another decline on Friday. So that's not a good sign when the up days are on light volume, but then Monday, Wednesday, Friday, the down days are on heavy volume, and you need to have that turnaround to show that the institutions are supporting the markets rather than selling off the markets. When I move to a weekly chart of the NASDAQ, you can see we sliced below the 10-week moving average, which is a key area of institutional support, and it's roughly coincides with the 50-day. The volume wasn't super heavy. It was slightly higher than the previous week. Nevertheless, there's distribution, and the leaders are struggling. Now, when I go to the S&P 500, I do want to talk about another thing I didn't like is this gap below the 50-day on Wednesday. Usually a gap below strong support levels is definitely not a good sign. Doesn't mean it's a warning sign. It's definitely another reason to be cautious when we gap below on heavy volume on Wednesday. Now, there's not a lot of examples or a huge sample size with this, but I'll show you three recent ones that come to mind. So we gap below in late February on the coronavirus news, gap below the 50-day. And then we saw continued distribution, and it ended up turning into this big decline in March. Now, the second example is October of 2018, where in early October of 18, just to give everyone perspective, Fed Chair Powell said he's planning on raising rates 3 or 4 times over the next year. Clearly, the market didn't like that. A lot of deleveraging needed to happen, and we had a gap below the 50-day in early October, and it led to a decline. Now, the third example is from late June of 2016 around the Brexit event, where we gapped below the 50-day on some pretty heavy volume. But this was an example of where we went down and then it didn't lead to a big decline. It was just a big shakeout. The market realized that Brexit wasn't a big deal, and then we turned around and ended up having a very strong market after the presidential election in November of 16. So going back to the current market, I've reset it back to this current market here. The big question I'm sure you're asking is this gap down below the 50-day, is this going to lead to a bigger decline like we saw in March of this year and the fall of 2018? Or is this just a potential shakeout like we saw around Brexit, where maybe the market needs to get through the election uncertainty and then we end up rebounding? That's a great question. Of course, nobody knows. What I personally like to do is stay defensive and let the market prove itself, maybe see some more stocks setting up, see the selling stabilize, maybe regain the 50-day. Keep in mind, I'm on top of the markets all the time, every day, and things can change quickly. So rather than predict, I'm just going to stay on the defensive side because we are below the 50-day. There is some distribution. There's very few stocks setting up, and I'd rather be patient and stay disciplined. Keep in mind, as I've mentioned, Stanley Druckenmiller's quote, and I'm paraphrasing it, when he says one of his greatest strengths is his ability to change his mind quickly. Even though I'm very defensive now, I'm not going to get overly bearish. I would just rather let the market prove itself before I feel more constructive and expose more capital to this market. Just keep in mind, it can change quickly. Now, I want to go over a few questions I got from some of the members. One of them is FOMO, fear of missing out. Somebody says, you know, I'm in heavy cash as well, but what if some positive news comes out after the election? By the way, it's not just the election that's the uncertainty. There's also the coronavirus numbers are spiking around the world, especially in Europe. They're closing a lot of countries down or slowly closing them down. And also the stimulus as a lot of small businesses and individuals still need additional stimulus passed by the government. So those are additional uncertainties. Nevertheless, somebody asked me, well, what if we just gap up after the election and they're worried about missing out? Personally, and sorry to give you some tough love, FOMO is weak. FOMO is for weak-minded people who just say, I'm worried about missing out. I'm worried about missing out. Again, I don't mean to be disrespectful. I'm coming from a position of I've studied some of the greatest traders in the world, and they all preach defense, defense, defense. In other words, instead of worrying about the market, so what if it gaps up 1% or 2% and you miss out a little bit? I'm worried about a potential gap or a move lower, and to stay defensive and let the market prove itself. A perfect example is March of this year. I was heavy cash when we bottomed. I was in heavy cash during this entire time. But then when we had the follow-through day on it was April 2nd. Sorry, this is the S&P 500. It was April 2nd on the S&P 500, April 6th on the NASDAQ Composite. When we had a confirmed bottom, this is where I made most of my money during this uptrend. In other words, when I reset the lines, there was no FOMO of, oh, we bounced off of the lows and I'm missing out. You know why? Because I also missed out on the majority of this decline. Again, that's my style. I'm an active manager and I vary my investment levels. My point is that the concern shouldn't be FOMO of missing out on the upside. It should be staying defensive and possibly worrying about more downside. So that's how I address the FOMO question. I got a couple other members that said thank you for mentioning these warning signs and for helping me raise cash because they dodged a lot of bullets this week. I'm grateful for those emails, and I applaud you for decision making because, as I've mentioned so many times, your ability to make decisions is what's going to give you confidence as a trader. So I'm proud that you're able to make those decisions and to when you see the warning signs and to avoid some of the potential harm. Now, I did get a couple of other emails where some people said, hey, I should have listened to you and I should have raised more cash, and they unfortunately got hurt over the past couple of weeks. It's not the matter of you should have listened to me. It's listening to the markets because I'm wrong all the time. I just do my best not to stay wrong. And this isn't a matter of listening to me. I'm just listening to what the markets are telling me and doing my best to pass those along to you, pass along that interpretation in these videos. So when we break below key moving averages, when stocks are acting weak, when the leaders aren't acting well, and there was too much bullishness a couple weeks ago, that's where I encourage people to listen to the markets, and I'm just trying to pass along what I see. Somebody else said, how do you deal with the psychology of the losses, specifically giving back 2 or 3 months of gains in just 2 or 3 weeks? And my honest answer is this happens to everybody. It's happened to me more times than I care to admit in my career. I think one of my biggest strengths is when we're in these strong uptrends is identifying them and trading the proper growth stocks effectively. One thing that myself, just being perfectly honest, and if anyone tells you differently, they're full of shit. One thing I'm trying to improve on is I've given back too much of those gains in the past. So I've tried to improve on that in really 3 ways. One, you got to be honest with yourself and say, hey, I've made a lot of money. Unfortunately, I give too much back. I got to make some improvements. Number 2 is by taking profits into strength. So when you see these types of blow-off moves that we saw at the end of August, or this strong move that we saw in the beginning of October, instead of cheerleading, which is what I used to do in the past, and I used to say, oh my God, I'm the best and I'm making so much money, that's great. Instead of cheerleading, reduce your emotions. And when you get that feeling that you think you're that good, because none of us are that good, I try to shift my emotions into being calm and to take some profits into strength. And then the third one, which is a lot easier said than done, is to stick to the discipline, to cut some of your losses, to reduce your trading, to cut some of the losers in your portfolio. And it's a lot easier said than done because no one wants that finality of cutting the losses and reducing, because what if it turns around? But that is how I've made the adjustments into not having as big of drawdowns, is by taking profits into strength. And when the warning signs show up, you have to stick to the discipline. Now, Someone else has told me that's great that you're in cash, but what about ideas? I need ideas. It's kind of like in Wedding Crashes where they're like, shut up, clown, make me a bicycle. Look, I'm not going to force it. I'm not going to give ideas when there's no ideas. One of my objectives with this product is to keep you on the right side of the market. When it's strong and things are healthy, I'll give you ideas all day long that are setting up and provide strong, safe entry points. However, when I'm not finding ideas, I'm not going to force it. I'd rather stay defensive and be patient, and don't worry, there will be another uptrend. I'm looking for a sustained uptrend, the keyword being sustained. I don't see it yet, but one, things can turn around very, very quickly, and two, there will be plenty of opportunities when those things turn. One other thing I want to address is some people have told me that I'm longer term and moving to heavy cash doesn't work for them. I applaud that. I completely respect that. I think that's great that you've defined your time frame and you understand your own objectives. However, the only thing I'll say to that is that you have to accept declines when you are longer term. I personally don't like to sit through 30-40% declines in 3-4 weeks like the S&P and Russell went through in March. I want to, honestly, I don't think anyone wants to sit through that. But if you're longer term, and by the way, I'm not saying that that's what's going to happen now. I'm just making the point that when you are a longer term investor, you have to deal with volatility and drawdowns. A perfect example is even when Carl Icahn made his $2 billion in Netflix, when he held it over 2-3 years, he held it through 3 or 4 30 to 45% declines 3 or 4 times to make that big gain. So my point is, longer term investors, if you can accept the volatility and accept that you're going to have drawdowns, that's fine if that fits your stomach and your objectives and your risk tolerance. And there's nothing wrong with being longer term. I still think even if you're longer term, there still needs to be a loss cutting discipline with the stocks that are really breaking down. And there's nothing wrong with keeping positions light and having a little bit of cash in case we go lower. Now, really quick, going back to the NASDAQ, I do encourage people to screen, as I've been doing, maintain a watch list in case we don't go lower and things stabilize. You always want to be on top of the markets. But the last thing I want to address is sentiment, because I talked about when we started to pull back here from roughly October 13th to the 23rd, I was just surprised to see sentiment increasing. Somebody asked me, has sentiment reached the extremes that you're looking for a bottom? I will say that sentiment definitely, the drop this past week was about 5-6% in the major averages. The drop this week did increase some fear in the markets, by no means at any sort of extremes, but you don't necessarily need them to reach extremes to reach a bottom. You just need some sort of fear to pick up. So the direct answer is yes, some sentiment measures definitely have picked up as far as fear goes. But again, keep in mind, sentiment is a secondary measure to the price action of stocks. So I really want to see stocks firm up and signs of the institutions coming back in. Again, the key word is consistently, to hopefully get the type of strong, 4 to 8 week, 6 to 8 week uptrend where you can really trade stocks for a decent time frame for a lot of swing traders or people who like to hold things more than 10 minutes.